Bloomberg Audio Studios.
Podcasts, radio, news.
Welcome to Merryn Talks Money, the podcast in which people who know the markets explain the markets. I'm Merryn Somerset Webb. This week we talk about why and how to buy into the UK, how the recent M&A surge is highlighting the opportunity in our domestic market, and what might happen ahead of the budget later this month. My guest is Wright, portfolio manager at Fidelity and manager of the Fidelity Special Values Investment Trust and the Fidelity Special Situations Fund. We started by talking about the difference between those two investment vehicles.
So the investment trust, which is special values, is about 95% the same as special situations, which is the open-ended version. So it's just the difference is about 5% in gearing. Unusually, both funds can actually gear, and both funds do so using sort of CFDs. That's very usual for an investment trust, but actually fairly unusual for an open-ended fund. But for all intents and purposes, they're extremely similar.
So if you're an ordinary retail investor and you're looking at both of them, what criteria are you using to choose between? Obviously, one is open-ended and one is closed-ended, but from the point of view of an investor, what's the difference?
Well, so I think that the key thing that's different is obviously because the investment trust trades day to day, you get a discount or a premium. And the trust has been, well, I've been managing it over the last 12 years. It's been on anything as high as a 14% discount. Or as high as a 3% premium. And so I guess as an investor, what discount you buy in at obviously affects your returns on that product, even if it performs exactly the same as special situations. So it tends to be people that are making like a regular savings. And to be honest, I do this with my Fidelity pension. That goes into special situations because that buys every month and I don't get a choice of when to buy. Whereas my investment in special values, I tend to wait until the discount is bigger and buy at those times and then trim my holdings when the discount is evaporated and therefore you can get a sort of higher percentage return by sort of playing that discount as well as the underlying performance of the fund.
And right now, investment trust discounts are pretty high across the board. I was reading something yesterday that suggested that's because holders of investment trust tend to be quite long-term investors, so they're likely to have quite big gains. They're worried about capital gains tax coming, so there's more sales in the investment trust sector than elsewhere. Hence, discounts recently widening even more than they have before. That makes sense to you?
That's right. So special values is on about an 8 to 9% discount currently, which is towards the upper end of where it's been, although not that different actually. So if you look 12 months ago, we were on a somewhat similar discount, but we did narrow up a bit earlier in the year and we have widened out a bit recently. And I think that explanation in terms of the CGT based selling is probably fairly accurate actually, because the returns of the trust have been very strong over a long period of time and people who are in it generally have some pretty good gains, including in the last year. The trust's up about sort of 24% in the last year. So people have been, I think, locking in some of those gains ahead of the budget.
Yeah, it's fascinating, isn't it? A reminder to everybody that taxes can often drive behaviour. I wonder if the government is listening. But the long-term performance of the two vehicles is roughly similar?
So special values has outperformed special situations over time. It varies by the year, but probably by 0.5% to 75 basis points per annum. So actually, that's quite meaningful on the 5% difference. Also, there's a bit of a timing difference in when I took on special values. I took it on before special situations. And actually, that was a particularly good time, 2012 and 2013 for the trust right out the gates. So even though the vehicles are extremely similar today, actually their long-term performance does look quite differential, even though their more recent performance has been much more in line.
Okay, great. All right, that sorts all that bit out. On we go. Let's talk about the UK market as a whole, because obviously you are mainly a UK investor. Now, when this new government first came in, I think you were pretty optimistic, and I was looking at notes written by you and your colleagues around the time. Labour Party's policies aimed at fostering growth and stability, et cetera, may prove an inflection point for UK assets after years of underperformance. We definitely got the years of underperformance. We're a little dodgier on the inflection point at this point, aren't we? And that the UK market has been holding its own, but not necessarily moving anywhere fast.
Yeah, I think that's right. Although... Again, we talked a little bit beforehand that the UK market has actually performed as well as the Nasdaq over the last 12 months. So it's actually been sort of 4 years now since the trust has underperformed the US. So yes, there was a very painful period of underperformance for the UK market, particularly from sort of 2015 to 2020. But that feels quite a long time ago. And actually, the UK market, I think, has been doing sort of just fine. What is true, though, is that it's been doing just fine because earnings have been quite good. And actually, the low valuation of the UK market, which sort of occurred post-2015, has not corrected. So the UK market remains very cheap, particularly versus other international markets.
Yeah. And it doesn't necessarily feel right now that we're getting that sense of growth and stability and the run up to budget. There's so much. We just talked about capital gains tax, but there's so many other things that seem very up in the air at the moment. There was this idea before this government came in that they would provide a sense of certainty about tax and a sense of certainty about the environment, but we haven't necessarily got what we were hoping for there.
Yeah, I think the issue is we haven't really had very much at all yet. So obviously the budget is the first test of that. So it's sort of a wait and see. I think you're right. All the rhetoric has definitely been positive, and Labour have very actively engaged with the city and corporates. So again, when I talk to big banks and insurance companies, they were regularly talking to Rachel Reeves, both pre-election and immediately post-election, about sort of what can be done to improve growth, what can Labour do to sort of help the economy, because clearly the best way to get more revenue for the government is for the economy to grow, and therefore sort of the taxation to increase naturally as GDP and companies' profits and consumers' incomes goes up. So that's definitely a laudable aim, and I think that sort of Labour have made very good noises. The question is obviously, is that alone going to sort of be enough? And there is a potential for obviously tax rises in the budget, which are generally negative, obviously, for the economy when you see higher taxes, whatever they may be.
Yeah, I mean, with the last government found out that simply repeating the word growth over and over and over again doesn't actually produce growth.
Yeah, that's right. And obviously stability has been the key issue. Obviously, a sort of Brexit, pandemic, and then obviously a succession of different chancellors and prime ministers has been very unhelpful. So just the fact that Labour do have a large majority and seem a lot more stable than the previous government, I think is a help. Also, some of the planning reforms are definitely positive in terms of sort of building more houses, making it easier to build and faster. That is definitely positive, but obviously it's early days in terms of the actual economic policy and what's going to come out of the budget.
Yeah, well, we'll have to wait for the budget for that. I've just been writing, obviously I'm mildly obsessed with capital gains tax, so I've just been writing about it, and it is it's fascinating to see this expectation that has been built up that the budget will be very bad, i.e. suddenly capital gains will be aligned with income tax. But one of the things that's very likely to happen is what always happens with this kind of thing, and that something will happen, but won't be as nearly as bad as everyone said. So it's more likely to be something like 30% than 45%, and everyone will go, oh, thank goodness for that. And what would have been seen as quite a big tax rise previously is suddenly seen as quite a small tax rise.
Yeah, certainly. I think, and to be honest, that's politics for you. It's always best to set the expectation like bad. So actually, even something that might have been seen as bad actually comes as a bit of a relief. I think as well, if you're thinking about what rate of tax actually maximizes the tax take, I think a lot of international studies have shown a CGT rate of around 30% probably actually maximizes your take and stops people moving offshore, stops avoidance, etc. because the cost of doing that. So the question is are you doing it for ideological reasons, or are you doing it for actually revenue raising reasons? But we have to wait and see.
We'll find out. Exciting times, Alex. Right, let's talk about how you invest. You are an unusual thing these days. You're someone with a bias to value.
Yeah, so the makeup of the fund, and as it's always been since Anthony Bolton launched it in 1979, is a value contrarian vehicle. And I think it's always been a bit contrarian to be a value manager. But actually, I'd say increasingly, because growth has been so much in the ascendancy over the last decade, it's become sort of very contrarian. And definitely you see that the number of sort of big rivals that were sort of in this space 10 years ago that now aren't around. And so you're right, there are less people in the UK market investing in this way because it's been a hard way to invest, and obviously also a market that's been hard to get money into, with the UK sort of being out of favour as well. I think the good news about that is obviously contrarian, going against the crowd. The more you're going against the crowd, the more chance you've actually got of sort of outperforming and finding hidden gems. The more people that are looking at stuff, the more competition makes it harder to sort of add alpha. So on one side, it's bad. It's been hard to keep money in the sector, and there's been lots of outflows. But in terms of the opportunity to outperform, I think it's actually quite a nice setup.
Okay, so you're looking for the companies that other people can't find, the unloved companies sitting around, but not the value traps, companies that you feel will have some kind of catalyst that will move them forward. So unlike we often say to retail investors, you don't need a catalyst. You just need to find a reasonably good company and sit there and wait because no one's judging you on a quarterly basis. But that's not quite how you look at it.
I think the danger of buying stocks without any conceivable catalyst is clearly that value trap. So that there are areas of the market where things potentially do structurally change, and therefore companies are cheap for a reason, and actually therefore you don't get good returns just by sort of buying everything that's cheap, because some of them will continue to be cheap, and in fact they may actually stop being cheap over time if their earnings just continue to sort of degrade. So we do a lot of work on the basket of stocks we look at is those cheapest stocks, but then we do a lot of work to try and sift out those ones we think where the story is structurally impaired, rather than just there being a short-term issue that actually over time should work out, and you'll see more people invest. So for me, the greatest ideas are ideas that we buy that people think it's a value company, they think it's a poor company, but actually when I come to sell, growth investors are buying it because actually they think it's a great company and it's going to grow consistently. Those are the very best returns that we get in our fund.
And not tempting to hang on rather than sell it to a growth investor? Or you just don't want to get involved in that style swap?
No, so I find it difficult to sort of think, what's this company going to do over a 5 to 10 year view, which is what you have to do as a growth investor. I think it's very difficult to actually predict the sort of the long-term trajectory of stocks, which once you get to a certain multiple, you really need to do, because effectively the earnings of the company aren't going to justify the share price until a very long way into the future. So we tend to try and think about a 3 to 5 year view, what's going to happen with companies, particularly where we think earnings can recover from a depressed level. And then if people really start paying up for that, we're happy to sell on. So you're right, often after we sell stocks, they do continue to outperform for a period. And so we tend to sell gradually, but we don't look to hold on to things once we think they're appropriately valued and that there are high multiples.
Okay, let's go back to the idea of the catalyst and what that might be. I mean, obviously in the UK market at the moment, one of the biggest catalysts for a share price to rise is M&A and mutterings about a takeover or an approach. And we're seeing an increasing number of companies in the UK disappearing from the market. I mean, when we come back later to the sharp fall in the number of companies listed in the UK and how this doesn't exactly help. But that is one of the big catalysts at the moment, isn't it?
Yeah, it's something that we've actually seen in the fund throughout the time that we've managed over a decade, that there have been consistent takeouts of companies. Because if you think about what we're buying, we have a big mid and small cap bias. So while we do invest in the larger cap stocks, generally 50 to 60% of the fund is in mid and small caps where takeovers are more likely. And then if you're buying something that you think is a good company, but it's at a low price, again, that's the kind of thing that either private equity or other corporates will look at and think, well, if we offer 75 or 80% of sort of what the fair value is, but that's a long way ahead of the stock price, we're going to be able to buy the company. And so again, if we're getting a fair price, we're happy to sell out of that. If we can, instead of holding for something for 3 to 5 years, we can buy it and sell it in 12 months. And that has happened. I think actually two of our big contributors this year, Essential and Smart Metering, were because there were takeouts. But actually, they're the only two in the top 20. So I wouldn't say the level of activity is actually significantly higher in the portfolio than it's been over the last sort of 3 or 4 years. It's sort of been fairly consistent, actually.
But it's quite encouraging. Is it across the market as a whole to see people noticing that this is an inexpensive market?
Oh, definitely. Like, I suppose what's strange is that for quite a while now, as I sort of said, ever since sort of things calmed down post-COVID, come sort of 21, 22, you've seen a heightened level of takeover activity, particularly from private equity and US corporates, because they're looking at the high valuations that companies trade in the private markets or on the public markets in the US, and they're sort of thinking, well, there's a huge arbitrage gap here to something that's quoted in the UK, and they're taking advantage of that. I suppose what has been strange is until the last 12 months where the market has perked up a bit, is that hasn't generally sort of caused other people to buy, and particularly it hasn't caused UK investors to buy back into the market. So one subset of buyers is very excited about the valuations in the UK, but that hasn't sort of spread to a wider set of buyers.
What might bring UK buyers back into the market? And we talk about this on this podcast all the time. And John and I were very pro the Brit ISA and quite irritated when it was removed, because we were thinking about ways to send a signal to the market, the global market, that the government is supportive of the UK market. But obviously, we're not going to get a Brit ISA. What do you think might bring people back into this market?
It's a tricky one, because I think generally sort of performance, people chase sort of recent performance. So unfortunately, sort of retail investors like to sort of invest into something that has been working rather than something prospectively that's necessarily going to work. But again, I've been surprised that the better performance of the market itself has just not turned things around. And maybe that's because you've effectively seen other markets also produce very strong returns. So people have sort of got used to actually high returns being the norm by investing in stock markets. And that hasn't been the case over time. The degree of outperformance and absolute performance from the US market has been extraordinary over the last 10 years and is extremely unlikely to continue. So I think, unfortunately, probably what gets people interested in the UK market is the US market falling. That seems to sort of be the key driver for everything now, because it has been so dominant in the narrative. So things like the British ISA, it would have helped, but I think it's really the US market has become dominant in kind of all conversations.
Interesting. I mean, there are an awful lot of people who genuinely believe that the US market has always been this extraordinary, that its outperformance is kind of been permanent, where in fact it really only started, 2015-ish, you began to see that outperformance really get going. And so it's perfectly reasonable to suspect that it will come to an end. And of course, for UK investors, a lot of those outsized returns have been driven by the currency as well. You know, strong dollar has given them a double whammy on top of the market. And as both those things turn around, it's perfectly possible you might see people going, oh, maybe a little home bias wouldn't be such a bad thing after all.
Yeah, it's sort of extraordinary. You're right. The US market actually did very poorly in the market prior to the GFC, sort of pre 07. It'd been a sort of structural underperformer, and US shops are increasingly building international teams. It was all about international diversification and growth, and that feels like a very long time ago now. And many market practitioners weren't even in the market at that point, which is why there's sort of this view among a sort of subset of investors that the US always outperforms. That was definitely not always thus. And also where the US came from, like, why has it performed so well? Well, some of these companies were trading very cheaply back in 2010, 2012. You could famously obviously buy Apple on single-digit PE, Microsoft almost on a single-digit PE. So in retrospect, those were amazing buys, but those valuations are now in the 30s. So yes, there's been good earnings growth, but there's been a huge amount of multiple expansion there, which you haven't seen in the UK. And to be fair, in other markets globally as well. So I think the UK is particularly cheap, but actually I'd say pretty much every market in the world except the US looks a lot more reasonably valued.
Exciting. So do you think, Alex, if we get together in another decade, we can sit here and talk about the regular outperformance of the UK market and UK exceptionalism, etc.? There'll be a little reversion to the mean, and young people coming into the market now in 15 years will think that it's the UK that always outperforms, but making the mistake that if you buy something cheap, it's going to outperform.
Yeah, so certainly on a 10-year view, I definitely think that the performance of the UK market will be better than the US. Like, definitely. Now, it's not going to happen every year, but definitely on a longer term view, I think it's a far more interesting proposition because of where the valuations are today. You can look at all the academic literature that over time, the biggest determinant of performance over a long time, so not over 12 months, on 12 months it makes hardly any difference, but the biggest determinant on a 10-year view is what price you paid for the asset in the first place.
And John and I are always saying this, and no one believes us anymore. No one believes us anymore because every year we're proven wrong by the US market.
Yeah, it's been an unusually long period of outperformance. But as I said, it's sort of strange that it is a period of outperformance that kind of finished kind of about 4 years ago, but no one really seems to have noticed. But it's not that other markets have sort of just performed in line with the US. So I definitely hoped that the narrative might change when obviously 22 was an incredibly poor year for the US market compared to other markets. But obviously, as things then roared back again, I think people sort of forgot about just how bad that year had been and just how much volatility there was. That's the other thing. There was a lot of talk actually when I started in the city, which was all the way back in 2001, just how concentrated the UK market was and how the FTSE was a bad benchmark because the large companies were so much, and therefore like a tracker was a really bad thing to invest in. But actually that's the US now. The lack of diversification when you're buying even a global tracker now is actually quite scary, just how much of that is made up with just a few companies.
Yeah. And I think a lot of people don't quite understand what they're buying when they buy those big global trackers, that they're effectively buying US tech. But we have talked about that on this podcast quite a lot. So I hope the information is getting out there. Let me ask you about one of the things that I think has been a long-term drag on the UK, and that is our productivity problem. And I know you talked to a lot of companies, spend a lot of time talking to company management. Do you see any sign in the companies that you invest in, or on a wider basis, that there is any turnaround here, that the productivity revolution we kept being promised via digitalization and technology, et cetera, is that happening?
Yeah, so I guess it's very difficult to sort of look at a sort of a country's GDP versus sort of the market in terms of sort of productivity, because I think certainly when I look at my portfolio and in terms of what companies are producing and what they're doing in terms of output for the number of employees, definitely companies across the board are improving their profitability. Sort of digital investments definitely mean that you need less people to produce the same amount of output, particularly post-COVID with the sort of use of digital tools and sort of remote working, offshore working, that there's definitely been a speed up in terms of companies' ability to produce the same for sort of less cost. But obviously when you see that in the UK productivity stats as a whole, that isn't necessarily translated. And that's obviously, there's two disconnects here. Obviously, it's only the larger companies that are on the stock market. So the vast bulk of economic output in the UK obviously comes from SMEs, which aren't on the stock market. And the fact that obviously 75% of the stock market in the UK isn't companies where the operations are based in the UK anyway. So there's a huge difference actually between UK PLC in terms of the country and actually the sort of the UK stock market that we're investing in.
Okay. Let's talk about the portfolio then. Let's go to the fun bit. Is there a sector bias in it or a shift in sectors that you're finding at the moment? How's it positioned?
So we try and invest right across the market, and we do so in everything from sort of £100 million market cap companies all the way up to £100 billion market cap companies. But I'd say over time, the sort of the value contrarian sort of streak in me has sort of, because of the nature of the market over the time that we've been running the fund since 2012, has led to actually financials being the biggest weight of the fund pretty consistently. Because I think that has continued to be a really unloved sector. It's obviously also a complicated sector that I think sort of smaller investors shy away from. And obviously there was and continues to be a lot of regulatory change there. So there's multiple things you have to be on top of, which I think as a big house at Fidelity, we can be on top of. We have regulatory affairs. We obviously have our own financials business in platforms as well as in investments. We have specialist banking analysts, insurance analysts, etc. So that's been an area that's been very big for the fund, and indeed actually very fruitful for the fund over the whole time. particularly so from insurance companies earlier on, but more latterly from the banks. So we own the likes of NatWest, Standard Chartered, Barclays, and the fund today.
And will that change as interest rates fall?
So I think clearly interest rates increasing has been beneficial for the banks, but I think what a lot of people miss and why people are staying out of the banks again is the sort of simplistic view that you never want to own banks when interest rates are falling. Well, that would be the case if you were having to pay high multiples for the banks, because lower interest rates do lower the earnings of the banks. But actually, what was really painful for the sector was the era of zero interest rates. Because if you think about it, banks find it very difficult to charge people to have accounts. So the lowest you can go in terms of a current account or a savings account is zero. And if interest rates in terms of on the loan side are down at that level, it's very difficult to make a spread. So I think there's nothing really to fear from interest rates falling from 5% down to 2%. Again, that's probably lower than most people are expecting. There is a lot to fear if that 2% goes back to 0.5%. And so I think banks will remain a good investment and highly profitable if interest rates stay in a more normal range. If they go back to zero, banks won't be a good investment.
And what about another theme that you have quite a lot of in the portfolio, which is the life insurers?
Yeah, so the life insurance companies, I think, again, have been sort of much maligned. So they were very much sort of lumped with the banks in the financial crisis. But actually, they did an awful lot better because they didn't have sort of lots of bad loans like we saw for the banks, where there was sort of very poor lending practices sort of through 2005, 2007. And actually, the structure of those businesses have changed quite a lot. So that the Solvency II regime, I think, was very helpful, particularly for the UK life insurers that don't have guaranteed products. And so the performance of the UK life insurers has been very strong all the way from sort of 2012 to recently. And particularly as those operations have sort of become slimmed down, lower cost, and so Aviva would be the biggest of our positions there. That's been very positive for shareholders. And in fact, Aviva are pretty much in all the areas that you'd want to be in that are sort of structurally growing. So they're very big in wealth and B2C platform. So for consumers to invest direct. They're also very big in workplace pensions, defined contribution, as well as sort of non-life insurance. And so they're pretty much in all the growth areas, and yet they're still pretty much trading as a sort of no growth, sort of volatile business on sort of low single digit Ps with a yield in the 7 to 8% range. So a huge improvement in the business, but yet not paid for by the market.
I suppose one of the great growth areas there, as you say, is the DC pensions, that pretty much everyone listening to this will have been auto-enrolled into a defined contribution pension of some kind, and those assets are just rolling up, an awful lot of them inside the life insurance companies.
Yeah, definitely. If you look at the biggest players in that, it's the life insurance companies. So Aviva and Phoenix, which is another holding, as well as Legal & General, which we've owned historically, but we don't own today. That if you've got a good low cost offering, and it is a very low cost business because revenue margins are small, that the revenue growth is very high because it's still a reasonably nascent business. Most DC pots are still quite small because the vast majority of people retiring today still have DB pots. But over time, that will become a much bigger business, and therefore being a big player in that area is very positive. And these companies also do very well out of defined benefit de-risking as well as companies sort of transfer that in. So even though DB is a dying product, actually there's still a lot of money to be made from that as those pensions pay out over the next sort of 30 to 50 years. So there's still a lot of value to be had from the insurance companies from that side as well.
One of the biggest holdings in both the trust and the fund is Imperial. That's a long-term holding that you'll keep?
So So again, our average holding period for things is 3 to 5 years. We bought into Imperial back in 2018, and we have added to it since then, notably in 2020. And it is the biggest holding in both funds. So it makes up about sort of 4.5%. So again, I think this is a really unloved sector. Tobacco is a sector that an awful lot of people will not invest in. And I think that's also been the case for quite a while, but even more so as you sort of saw the big push to sort of ESG and responsible investing in the sort of 18, 19, 20 period. And so I think that opens up a real opportunity. People not investing for effectively when people are not investing for non-economic reasons. So they're investing for some other reason, which opens up an opportunity for people to prepare to invest in this area. Particularly when companies have excess cash flow that they can use in buybacks. So that's why I have a much bigger position in Imperial than I do in BAT, which I also own in the portfolio, is that their buyback is just a much higher percentage of market cap. And therefore, even with a top line in tobacco, which basically isn't going anywhere, profits in tobacco have been flat for a number of years. But if you can buy back 7 or 8% of your company every year and you only have to pay 6 or 7 times earnings for that, that's incredibly accretive on a per share basis. So the EPS, the earnings per share of the company, are actually going up probably at a faster pace than the market, despite that lower than market valuation, on top of paying a very good dividend yield of sort of 6 or 7%, which probably on itself is largely the long-term return of the market. So I think economically, that's a very attractive business that very few people are sort of prepared to look at.
Yeah. And how do you get that past your own ESG department and stewardship team?
So the beauty of this fund, as it's always been, is it's a go anywhere fund. So there's no restrictions from an ESG point of view in terms of what I can own. So if I think we're going to make an absolute good return on a company, doesn't matter what that company does, we're able to invest, which I think is a key advantage. Now, that doesn't mean we don't consider ESG concerns, because why did this area of investing become very big? Because there was a view that governments would step up their issues to deal with companies that produced externalities that were not good sort of socially or for the environment. Governance has always been very important. So again, appropriate governance is a key thing we do look for. I think the thing is, when you look at tobacco, though, and a bit like defence that we've owned a lot of over time, although actually we've now sold most of it because those companies were taken out by private equity or American suitors. Actually, I think tobacco is very aligned with actually what governments want. So governments every day, they want less people to smoke because it is clearly harmful and it is bad for people. And the tobacco companies very much back that up by putting the price of cigarettes up every year. So increasingly 7, 8, or even in some markets like the UK, 10% less people every year are smoking. That is exactly what the government wants. Now, obviously, the beauty of tobacco is that, yes, volumes might be going down 10, but if price is going up 7, actually profits are largely flat. And clearly, it is an addictive product. People who are generally on it don't give up, but new people aren't taking it up. So I think actually that from a fundamental and economic point of view, this is very aligned with what the government wants. And then obviously there's a lot of investment in next generation and lower harm products like vaping, like heated tobacco, like chewable tobacco. That again is an area where tobacco companies can make good profits, and increasingly actually BAT makes the same percentage margins now in vaping in the US that they make in tobacco. So there is actually more longevity to these stories than maybe there was in the past, and very much aligned with government's interests.
Interesting. Are there other opportunities that come as a result of there being sectors that other people don't want to invest in? Does that carry through for you to the oil companies, some of the big resources companies, for example?
So again, we do look at these companies, and we do have some oil in the portfolio. But again, I think it's sort of it's trickier in those areas because I think there has been an increase in taxation in that area, and it's an area that has been open to that because the public sort of negative perceptions for it. And so that's something that has actually hurt the portfolio, the increase in UK taxation in particular. Also, I'd say because of the size of those companies, 5 years ago, there probably was quite an opportunity there because increasingly particularly ESG funds weren't able to invest, but also other people sort of didn't think oil was a particularly interesting area. But because BP and Shell have been such great performers, actually increasingly if you look at most mainstream UK funds, they do own those stocks today. So that I don't think there's the same contrarian opportunity now. And increasingly, I've been selling down some of my oil holdings. Mining is also interesting. I haven't ever really owned much mining through the whole decade. And that's because that's quite, again, like oil, a very concentrated sector in the UK. It's only really sort of 3 companies. It's Glencore, it's Rio, and it's Anglo. And actually, demand for that product, because it's mainly out of China, has stayed much stronger than maybe I would have thought 10 years ago. China's use of commodities has stayed at very high levels. Now, obviously, it has come off a little bit more recently with the very publicized issues we've seen in China. But I think prices, particularly for iron ore, are still very high. So mining isn't a sector outside of some small caps that we've really owned much of in the fund over time.
One more thing I wanted to ask you about was house building. I see you own Cairn Homes. And we've talked a little bit about planning at the beginning and how house building may become a lot easier going forward. Is that a sector you expect to have more exposure to?
Yeah, so house building and construction is something a sector we've sort of been in and out of over time. And we did, back in the early days, own quite a lot as things were really recovering out of the global financial crisis and the euro crisis, but we very much did sell down our UK exposure, which was the right thing to do, so that we owned very little going into the Liz Truss budget, which was obviously very negative for the sector. Cairn Homes and Glenveagh, which are both big positions in the fund, while they are UK quoted stocks, they only operate in Ireland. And again, I think that sort of shows the differentiation of the product maybe compared to others, that in a sector that people have sort of perceived there being problems because of the rising cost of finance, that they very much traded the Irish house builders like the UK ones. Whereas actually, if you look at what's happened for both of those companies in the last year, both have produced record profits and record volumes, which is incredibly different from what you've seen in the UK. And that's very much actually down to government support. So whereas the UK government was incredibly supportive of the UK house builders coming out of the GFC with Help to Buy, a lot of government incentives, as the UK sort of house builders became very profitable, built more houses, admittedly probably not as many as the government would like, that they've actually sort of very much turned their tail and actually been pretty unsupportive of the UK sector since then in terms of higher tax rates, removal of Help to Buy, cladding provisions. Whereas in Ireland, you've seen a huge raft of incentives come in much later, but to be very helpful at keeping volumes up and keeping what is a much bigger housing crisis in Ireland, trying to alleviate that. So those two have been great performers over the last year and are big positions. And we only have a very small position in UK house builders, which we built more recently. So about a 1% position in Crest Nicholson, because I think the UK situation, while I think improving from here, and we talked about sort of planning, which probably will help, but that's a slow burn. It takes time to change. Like Ireland's been trying to improve the planning for about 5 years and they just starting to crack it now. So I think that will help over the life of a parliament, but probably won't help very much over the next 12 to 18 months.
Okay, it's a long game. A couple of quick questions. What's your newest holding that you can talk about?
Oh, that's a tricky one.
It wasn't a trick question, I promise. It was just a casual question and an easy one.
Yeah, no, it's tricky in that I'm trying to think about exactly what's relevant, but it sits within our 30-day disclosure requirement.
Yes, exactly, and that you've finished buying your position in for now, etc. I know it's not the easiest thing in the world.
So again, I think Tesco is something we've bought over the last 6 months, which is a big position that we've finished buying. Because I do think actually the UK consumer looks in pretty rude shape, which is unusual because when you look at sort of particularly sort of the US, where consumer spending's been really strong for a long time, that's a market that's much more worrying. And so I think Tesco is doing a really good job in terms of its market share. There's actually two very clear market share donors in that area. So again, that's what we like to see, sort of where supply is actually contracting, and Asda and Morrison's, because they're both very highly leveraged, are actually in the space where they're closing space, which is sort of helping all the other supermarkets. And Tesco's doing just a really great job at sort of taking market share, taking the fight to the discounters in terms of Aldi and Lidl with their sort of price match, and sort of just grinding it out. So that's a fairly unusual position, I'd sort of say, in terms of its quite large cap and its quite high market share, but something actually for what's perceived as a boring stock can actually be sort of quite exciting.
All right. Excellent. Final question. The clincher to the podcast. If I let you only invest in one thing and it was either gold or Bitcoin, you had to hold it for 10 years, which one would it be?
Yeah, so this is a fascinating question, and not that there's any question in my mind on the answer, which would be gold, but both of these assets have no intrinsic value. So I don't believe in investing in things with no intrinsic value, that I invest in companies that I think have earnings that should grow over time. So I would expect on a 10-year view, both of those assets to have very poor returns compared to investing in equities. That being said, gold has been around for millennia, and even though it has no intrinsic value, it has actually shown itself to be a reasonable store of value over time. And therefore, if I was to choose one, it would clearly be gold, because there's every possibility in 10 years that the Bitcoin could be completely worthless and might not even exist. As I said, on a 10-year view, I think it's very unlikely gold has no value.
Yeah, okay. That's kind of my view. I like it when people agree with me towards the end. Is there any market, and let's say that I were to take that question further out and say you could have gold or Bitcoin or any other asset class or market in the world apart from the one in which you specialize?
Yeah, so I'd probably say the Japanese market would be the most interesting after the UK, because I think it is a market where it's had a bit like the UK, a very, very long period of underperformance. And also not only have sort of valuations come back a lot through that period, but actually sort of companies' underlying returns have been very poor for a long time. And that is starting to change. So I'd say, yeah, on a 10-year view outside of the UK, which you expect me to say is probably going to be the best performer, I'd say Japan is the one I would pick.
Alex, you're wonderful. Thank you for letting me talk to you for so long. Enjoyed it enormously. Thanks for coming on.
Thank you.
Thanks for listening to this week's Merryn Talks Money. If you like our show, rate, review, and subscribe wherever you listen to podcasts. And you can keep sending questions or comments to merrynmoney@bloomberg.net. You can also follow me and John on Twitter or X. I'm at MerrynSW, and John is John_Stepek. This episode was hosted by me, Merryn Somerset Webb. It was produced by Summer Sadi. Production support and sound design by Blake Maples. And special thanks to Alex Wright.